Hello and welcome back to the Note. All appears to be well after a tumultuous week. We end with US stock indices at all-time highs, including even the Nasdaq Composite for the first time in 15 years, while world equities are also at all-time highs. This was despite a noticeable slowdown in US economic numbers, great concern over Greece in Europe, great concern over China, where the authorities appear to be getting a little desperate. Everybody was prepared for a correction in US stocks, particularly because earnings forecasts collapsed during the first few months of the year. It hasn't happened. Why not? Well, perhaps the most important reason behind that is that the economic softness has also had an effect on other numbers, most importantly the dollar. As you can see from this chart, the dollar has been on a remarkable uptrend for a while. It has finally today gone back below its 50-day moving average. That's an average showing its short-term trend. You can't say that it's definitively into a downward trend now, but the remarkable forward momentum it had has finally dissipated. When you have a weakening dollar, that gives some extra strength, some extra support to US equities. You similarly get that from the lower interest rates we're getting, which are also a factor of weaker economic data. Now, let's take a look at earnings. We've well into earnings season now. If you take a look at figures for the quarter, these numbers come from Thomson Reuters data stream. You can see that yes, we are doing slightly better than had been expected at the beginning of this month, but not dramatically so. Industrials are actually doing quite a bit worse than had been expected, and obviously energy is the disaster zone that everybody had thought. You're not seeing any more in the way of positive surprises than you would normally expect, and we are still at this moment on course for an outright decline in earnings for the quarter. Now, if we take a look at where forecasts for the whole of this year compared to 2014 have got to, you can see that, in fact, the continued pessimistic trend continues. This is compared to where we were on New Year's Day, and you can see that the outlook has been truly radically slashed. So although there has been, on balance, as you would normally expect, somewhat of a positive earnings surprise so far in this earnings season, compared to the very low bar that companies had set for themselves by talking down their prospects, it's hard to really say that earnings are a good reason why stocks are performing as well as they are. Now, for next week, we have yet more, many more earnings announcements from US companies. They will continue to be very important. It looks less likely that they'll provide the catalyst for correction now than it did a few weeks ago, but you still need to watch them very carefully. On Wednesday, we will hear from the FOMC. It's unlikely, I think, that the Fed will do anything that clearly rules in or rules out a rate rise in June. They certainly won't be raising rates next week. The possibility that they will say something that moves the market sharply has to be very high, because that's the importance of the Fed these days. Plainly, the risk of a sharp move downwards in response to a hawkish surprise is greater than the risk of a sharp move upwards in response to a dovish one, given where stocks are at present. At the end of the week, we will be starting the month of May, so that means we get the first of a raft of new economic data with ISM data for the US and around the world. That's also always very important, although we have to wait another week before we get the unemployment data from the US. It's unlikely that we will get a strong catalyst for the long-awaited correction here in the US next week. It's also just about possible that we will continue to see more octane if earnings really do begin to start surprising unambiguously on the upside. But we are in a very intriguing position where, despite all the reasons many people were braced for a correction, we haven't had one. Let's see what next week has to bring.